All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. If you've been searching the internet looking for information on investing in real estate using a life insurance policy, you've come to the right place. So be sure to like and subscribe to this video right now because you'll want to come back here and catch all of my new content. All right, today I'm digging deep into the Double Play archives again, resurrecting or producing a video that I recorded back in August of 21. And by chance, I'm wearing the exact same shirt today, and I guess I'm curious, post in the comments whether or not you like the goatee. It didn't stick around long. But today we're going to be talking about, should you purchase a life insurance policy, maximum overfunded life insurance policy, for the accelerated living benefits. Now, accelerated living benefits, they just pay a benefit to you if you suffer a critical illness or if you become chronically ill. You get part of the death benefit advanced to you. So a lot of people like those benefits. But the question we're going to address today is, do those benefits belong in a maximum overfunded policy? So stick around after the intro and we'll jump into the video from 2.5 years ago. All right, thanks for sticking around. I'm Tom Rutkowski with Innovative Retirement Strategies. So the goal of this channel is to demystify life insurance and give you the tools that you need to get a properly designed maximum overfunded life insurance policy so that you can maximize your wealth potential by investing in real estate by leveraging the cash value of a policy. But today we're talking about accelerated living benefits. And specifically, I want to give you the facts that you need to know to decide whether or not you should choose a policy that has these benefits. So if these benefits are important to you, you definitely want to stick around and pay attention to this presentation. But in this presentation, I'm not going to dive too much into the detail of life insurance and how it works. If you need a primer on permanent life insurance, I highly recommend watching my Life Insurance 101 video. There is a link to that in the description below. And it might also be helpful to watch the other video on maximum and minimum overfunded policies so that you understand the difference in what I'm talking about here. So while you're down in the description clicking on those links, be sure to like this video and subscribe to this channel so that you're notified whenever I come out with new videos. The goal of today's presentation is to have you understand that accelerated living benefits are part of the death benefit that's accelerated to you in advance of you dying. It's while you're still alive. And because in a maximum overfunded life insurance policy, we're keeping the death benefit to an absolute minimum, these riders have minimal value beyond the point where you stop making premium payments into the policy. So, all right, so before we get started, I just want to go over my typical financial disclaimer. There's no advice being offered in this video. No financial advice, no tax advice, no legal advice. And also the purpose of life insurance is for the death benefit protection, and any other benefit is purely ancillary. So with that, let's get started. The way I want to attack this today is I want to cover the basics, what are accelerated living benefits? And then I want to take a look at minimum and maximum overfunded policies and the impact of accelerated living benefits on those types of policy designs. And then I'll wrap things up and have you on your way as soon as we're done with that. All right, so what are accelerated living benefits? Basically, accelerated living benefits are an early receipt of your policy's death benefit because you suffered a specified condition. And most policies have three types of living benefits. The first one that most policies have is a terminal illness rider. And if you've received a professional medical opinion that you've only got 6 months to live, the life insurance company in this case will advance the death benefit to you while you're still alive. In the last dozen or so years, a lot more accelerated living benefits have been introduced. So you'll also find policies with chronic illness riders and critical illness riders. So a critical illness rider is a rider that will pay or will advance a portion or accelerate, right? accelerate a portion of the death benefit in advance of your death if you suffer any one of specifically named conditions, such as heart attack, cancer, stroke, end-stage renal failure, blindness, you have a transplant. The list goes on. But depending upon the severity of that incident, a portion of the death benefit will be advanced to you while you're still alive. The other type is a chronic illness rider, meaning if you cannot perform 2 out of the 6 activities of daily living, then a portion of your death benefit will be advanced to you. And all right, so now that we've covered the accelerated living benefits, let's take a look at what the impact of those benefits is in maximum overfunded life insurance policies. So I want you to go away understanding 2 main things. And again, if you've watched all my videos, you'll find that I cover a lot of the basics over and over and over again. And we're going to do the same thing here again today, because the answer to most of your questions when you're analyzing life insurance is found in that basic understanding of life insurance. So all I'm doing is giving you the tools that you need to make your own decisions. So today we're just going to apply those basics to the question of accelerated living benefits and whether or not you should put those benefits on your policy. So there are 2 main things that I want you to understand, is that the accelerated living benefit is part of the death benefit of the policy. And then also, in a maximum overfunded life insurance policy, we're keeping the death benefit to an absolute minimum at all times during the policy duration. So if you put 2 and 2 together, that means that we're reducing the benefit that you're thinking that you're getting here, because at some point in the future, when you stop making premium payments, we're going to reduce the death benefit to the absolute legal minimum, and that benefit may not be there when you need it. So I know that probably doesn't make sense, so let's take a look at some examples. All right, this is the typical maximum overfunded life insurance policy graph that I show in all my videos. And this is graphing the death benefit in orange and the cash value of the policy in blue. And the things that you want to take note of here are that at the policy issue, at age 45 for this client, we're solving for the minimum death benefit that you can possibly get for the amount of premium that client is paying. And then each year thereafter, that increment of death benefit is maintained and is just literally pushed up as a buffer between the cash value and the total death benefit. Now, at any point in time when you want to stop making premium payments on your policy, it's important that you lower the death benefit to the minimum non-MEC level, which is basically the minimum amount of death benefit protection that meets the definition of life insurance. So any less than that, and you violate that definition of life insurance. So in this case here, we're looking at a client who wants to pay or wants to stop paying after 10 years. So after 10 years, you'll notice that the death benefit drops substantially. You see a little cliff there that it drops off. And from that point going on into the future, we're maintaining the absolute legal minimum amount of death benefit protection on top of the cash value. And one thing I want you to keep in mind here to help make it make a little bit more sense for you, or help it make a little more sense for you, is that buffer between the cash value and the total death benefit. That's the amount of money that the insurance company is going to come out of pocket if you suffer death. The cash value, as you've heard me say many times, is literally the policy owners saving up the death benefit for the insured over the insured's life expectancy. So the cash value is part of the policy. So what I want you to do is think of it in terms of your money, which you could get back at any time or you can leverage against, and the insurance company's money. So in the beginning, like at day 1 of this policy, at age 45, there's a tremendous amount of the insurance company's money at stake. And then over time, it gradually shifts the risk over to you, the policy owner, so that you're providing most of the death benefit because you, through your premium dollars, have saved it up. Now, it's not that simple in a maximum overfunded design, but We're still barely complying with the legal definition of life insurance. So from age 55 onward, we're basically spending about 0.25% of the cash value on death benefit protection each year. So the idea that rising costs of mortality will cause a policy to lapse is absolute nonsense. And the other thing I want to make clear too is this graph that we're looking at is life insurance, permanent life insurance. It doesn't matter if it's whole life, it doesn't matter if it's IUL or UL. This is what a maximum overfunded policy design looks like. In the case of a whole life, what would happen is at that 10-year point when the policy owner wants to stop making premium payments, we're going to let the term rider that boosted up the death benefit in the policy drop off. And at that point, what you keep is the base policy and the value of any paid up additions. So graphically, it looks exactly like this. In the case of an index universal life, the software handles everything. We just literally go in and tell it to lower the death benefit to the absolute minimum level. It's a much simpler process. But in any case, beyond age 55, you can see that you, the policy owner, through your cash value, are providing the vast portion of the death benefit. So what does that mean in terms of accelerated living benefits? It means if you suffer one of those claims and you want your death benefit advanced to you, it's going to be coming from your cash value for the most part. And you can see it all through time. Like if you look at age 93, the very end of this, there's only a small sliver of risk that the insurance company is taking on. The rest of the death benefit, looks like about 95% of it is being handled by you through your cash value. So if your policy is designed for maximum cash value with the intent to create tax-free retirement income, or you want to leverage it using the double play, exercising those riders and taking advantage of those accelerated living benefits is basically going to kill your policy. It's not going to be available to provide retirement income any longer, and it's not going to be there to provide a bank that you can borrow against. So I know that was a mouthful, so let's take another look at another example of somebody who's younger and paying premium for a much longer period of time. This policy is for a 34-year-old female in this case. I believe she was paying $6,000 of premium per year, all the way out through age 65, where the illustration is showing that she's reducing the death benefit to the minimum non-MEC and then continuing the policy from there on. So again, even though it's stretched out over a much longer period of time, the same principles adhere as in the 10-pay example that we just looked at. Meaning on day one, we're solving for the least amount of death benefit that you can possibly get for a $6,000 per year premium. And then each year that $6,000, that death benefit is pushed up through the new cash value that's added to the policy through the premium. Now at age 65, you'll notice that just through the sheer accumulation of the cash value over time, that even at that point, the cash value, your money, makes up about 3/4 of the total death benefit. And there's still only that initial increment on top of the cash value. But for the purposes of the accelerated death benefit, those benefits are still there from that larger increment at that time. And then from that point on, the death benefit is reduced to the minimum non-MEC. And again, the cost inside the policy for that is about 0.25% to maintain that little sliver of risk and protection. And again, everything under the blue line is your money. Everything between the blue line and the orange line is the insurance company's money as a portion of the death benefit. So again, you can see that in this case, if she's healthy and she never uses the benefit, she's paying for it through whatever cost is built into the policy for that rider for that time period from age 34 out through age 65. And then when you when you think about it, age 65 and onward is probably the point in your life where you're going to need that rider the most, and it's not going to be there for you, or it's going to offer very limited benefit. I mean, at age 65, for example, once the death benefit is reduced, you can see that your savings, the cash value, makes up probably 80 plus % of the total death benefit protection. So the question now is what should you do? Now, in this case here, the death benefit doesn't have to be reduced at the time that you stop making premium payments. Now, in the 10-pay example that I showed you earlier, there you don't want to keep that death benefit high after only paying for 10 years. More than likely, that policy is the rising cost and mortality of maintaining that large chunk of death benefit protection. There's just not going to be enough cash in the policy to sustain the cost of insurance. But in this example, where she's been paying for almost 30 plus years, you can see that the death benefit drops by about half. And so the cost internal to the policy would be double what it was before, or what it could be in an optimally designed policy, but it's not going to cause the policy to lapse. Even if you kept the death benefit high in this example, the policy would more than likely last without any issues through the rest of her life. But the thing to keep in mind there is, again, if you're using the policy for tax-free retirement income and or you're using it for leverage, maintaining that higher death benefit is putting a higher load on the policy, because the insurance company is paying for that death benefit protection that they're offering you. So if you've got double the additional death benefit in there, you've got double the cost. And that erodes or eats away at the growth of the policy. So if your goal is tax-free retirement income, or if your goal is to maximize tax-free retirement income or leverage the policy's cash value, you want a policy with as low of a load on it as possible. So you want to make that death benefit reduction at that time. If these accelerated living benefits are important to you, and they should be important to you, a chronic illness rider, for example, the one that pays out if you cannot perform 2 out of the 6 activities of daily living, well, that's essentially, for all practical purposes, the same as a long-term care policy. That long-term care policies have the exact same trigger. If you cannot perform 2 out of the 6 activities of daily living for some specified amount of time, then the policy will pay a benefit. Now, the critical difference between the two is that a life insurance policy simply pays the benefit if you suffer that condition. Whereas a long-term care policy, you generally have to show receipts for the care you received, and it's more of a reimbursement plan. But it's up to a specified benefit until the death benefit is exhausted, or the benefit is exhausted in the case of a long-term care policy. So if these benefits are important to you, then we should probably take a look at a minimally funded life insurance policy. So here, this is my typical example of a minimally funded life insurance policy. In this case, this is you calling up the insurance company, asking the agent for the lowest price that you can possibly get for a $1 million policy for a 45-year-old, for example. So in that case, the insurance company is in a competitive situation. They know that you can call up other insurance companies, so they really want to collect as little premium as possible for that contract to perform. Meaning the policy owner is going to save up the death benefit over the insured's life expectancy. And you can see that here. Again, the orange line is the death benefit fixed at $1 million for the entire term of the policy. And the blue line represents the cash value, and you can see that it slowly but surely rises until it eventually reaches the death benefit out near age 113. And then at that time, once it meets it, it just simply pushes up the total death benefit because the policy is completely paid up. Now here, there is much more cost inside this policy. So much more of the premium dollars are going towards paying for the death benefit protection and the accelerated living benefits. So what I want you to look at here is if we look out at age 65, for example, you can see that the cash value is probably, looks like about somewhere $250,000-ish, maybe even a little bit less than that. And there's about $750,000 of the insurance company's money. So between age 65 and say age 85, the years where you would more than likely need a chronic illness rider or a critical illness rider, you can see that there's much more benefit available to you in this policy. You know, your cash value is only making up a much smaller portion of the total death benefit. So, and another thing to consider too is these riders are available on term policies as well. But again, on a term policy, it's going to expire long before you're going to need that benefit, more than likely. So I always recommend getting a permanent life insurance policy that will be there when you need it. All right, so just summarizing what we talked about, you know, again, there were two main things that I wanted you to understand, which are really just basic life insurance. And that is, in any maximum overfunded life insurance policy, the death benefit is being kept to an absolute minimum at all times. And accelerated living benefits are paid for from the death benefit. So we're, by definition, keeping those accelerated living benefits to an absolute minimum at all times. So if they're important to you, I highly recommend that you get a separate policy dedicated to death benefit protection and the accelerated living benefits. All right, so that was a fairly short video for me. If you're hungry for more information, I highly recommend going out to Facebook and joining my double play group. That's a community of people who are doing the double play or looking into the double play, but it's a forum where you can ask questions of people who are actually doing this, not a life insurance agent. But if you want more information on life insurance, I highly recommend going out to my website. I've got blog posts and articles that usually correspond to a lot of these videos. My YouTube channel is great. I've also got tons of recorded webinars available that you can view that answer most of the questions that it's going to answer almost all of the questions that you're going to have as you research whether or not leveraging the cash value of a maximum overfunded life insurance policy makes sense for you. So be sure to check those out. There's also a link to my calendar if you want to set up a call with me and discuss a policy or have me take a look at an illustration that you already have to make sure that it's designed right. I can do that for you. All right, one more thing. If you do have a question, go ahead and use the comment box down below and ask the question. I monitor the comments very closely and I'll respond very quickly. And other people can get the benefit of seeing those questions and answers in the future. So, but with that, I will see you next month when I create my next video. Thanks.